The way that this topic came to be, I think, as we were trying to figure out how do we get some of our energy thought leaders in Houston in one spot and be able to pick their brains at the same time that NAPE is going on and we have students coming here and really just be able to get you and your brains out in front of everybody here in this fascinating time in our industry. It really is. So I asked each of them to prepare a quick intro, tell us a little bit about yourself and your career thus far in this space, and then how are you defining the energy transition? How's your company managing it? And we're going to spend the first 20 minutes, each one of them giving us a little background on that, and then we'll have some Q&A. So we'll start with you, Walker.
Thank you so much, and good morning, everybody. My name is Walker Moody. I'm the president of Pickering Energy Partners, and I'm a TCU alum. Go Frogs. I'm so happy to be here. It's the first one of these, as we all know, in 2 years, and it feels like it's been longer. At Pickering Energy Partners, we're a boutique financial services firm. We've been around since 2004. Many of you may have known us as Tudor Pickering Holt. You know, there's massive demand to decarbonize the existing energy system. That's coming from governments, it's coming from consumers, and it's coming from investors. But it's extremely expensive. And when we think about it, it is, the International Energy Agency says it's $150 trillion to decarbonize our energy system by 2050. And let's think about that for a second. That is $5 trillion a year. You know, the most money our industry, the energy industry, spent ever was in 2014, and that was 800 or 900 billion. Yeah. Think about, it is 10 times bigger than the entire U.S. shale boom. And we thought that was a lot of money. Many of us in this room made a lot of money during that time. It's so big that it's hard to wrap your head around. And the energy transition has unfortunately been dubbed an all or nothing issue. It's fossil fuels versus the energy transition. And the reality is it's globally, and I think we would all agree, the energy transition is a good thing. You help the planet, you hopefully lower energy needs or the utilization, and number three, you create a lot of high-paying jobs. Here in Houston, the Greater Houston Community Foundation is trying to, and the Greater Houston Partnership is trying to pivot and make sure that Houston is not in the buggy whip manufacturing business here in 20 years. And we want to be a hub for the energy transition too. That's why it's important that institutions like TCU, our alma mater, and what they're doing here. But the reality is when you think about the time that it will take, you have to understand, to decarbonize our energy system by 2050. There's a couple of things, and I want you to think about this. Number one is we will need, the world population is going to double. No, excuse me. The world economy is going to double by 2050. And we're going to add 2 billion people to the planet. In order to go to a zero carbon world by 2050, we are going to need to use 5% less energy. So you're going to double the economy and you're going to add 2 billion people and use 5% less energy. Number two, in order to truly decarbonize it, you're going to have to build and put into service a solar power plant equal to the largest that we have in the world today every day between now and 2030. And you're going to also need to not produce any new oil and gas after this year. All done. Oh, and another thing, we're going to need every automobile sold by 2030, 6 out of 10 to be electric vehicles. 6 out of 10 globally. That's not just here in Houston. I see a lot of Teslas outside. We're talking globally. So the likelihood of that, plus you're going to need synchronization between world governments, Russia, China, and the US, on almost every facet of trade, energy utilization, and information. There's something going on in Ukraine right now which would tell me that would be a challenging thing in and of itself. But that's what we at Pickering Energy Partners call the reality gap. we agree that it's important, and we're pivoting our business to make sure that we're not just energy experts for upstream, midstream, and oil field services, but we hired a battery analyst last year. We have our market intelligence business Insights is writing reports on Tesla. I'm from Midland, Texas. I never thought in a million years I would be looking at investments in electric vehicle infrastructure and carbon sequestration. I can't believe it. But the reality is our business will likely have 25% of our revenues from the energy transition, I bet, in 2 years, up from 12 today, which was up from 0 2 years ago. So it's important, but for everybody in this room, the way that we look at it, this reality gap is hydrocarbons, traditional oil and gas, are going to remain very important to our energy systems for the foreseeable future. It's not either or. You have an opportunity to, you don't need to set this up as a Hatfields versus McCoys or TCU versus SMU, which I know is a little weird now that he's our coach, but we'll get over that. And so the way to think about this is we are not drill baby drill, and our industry cannot be, nor windmills on every corner. We need to make a concerted effort to change the energy mix ourselves and not make the dialogue a versus situation. Thanks.
I like that I don't know if you can hear me still. Might need to move that up. I like that our frogs are not lacking in their opinions. Thank you, Walker. David, go on, please.
I think overall what's interesting is like you said, energy transition. When I was thinking about some of the questions and history here. So when I graduated from TCU, it was 96, and I joined this little company at the time that was really growing, and the hype thing then was marketing and trading. It was Enron Corporation. So they had an analyst and associate program, and I joined that coming right out of school because I didn't know if I wanted to do investment banking or consulting, and Enron at the time was a good alternative to that, and a lot of smart people, a lot of good folks there overall. So I was there, transitioned in '99 to Kinder Morgan, and when I left Enron, a lot of people thought that was kind of nuts to go to a company that was focused on hard assets and cash flow. And at that point, Kinder Morgan was not a sexy company in the least bit. It was small. It was very different in that we didn't have any marketing and trading. And again, at that juncture in Houston in particular, there was such a focus on Dynegy, Enron. I can go through the names that were just focused on marketing and trading. And their focus, again, at Kinder Morgan was on cash flow. So we went through, like you said, the boom days of shale. It was amazing to see at Kinder Morgan, my background there. I headed up their M&A group. I was treasurer, and I was head of IR. So I kind of got to see all facets of the company, both leading deals, but also financing deals. And it was a very transactional time. I remember, as Walker was highlighting, drill, baby, drill. And different comments like that. We went public, we went private, we went public again. We acquired El Paso Corporation, which was the largest energy company, which created the largest energy company at that time. So there was a lot of transition then as well. And when I left in 2013, I formed my own holding company called CGK, where I wanted to be able to invest in private energy companies and also real estate operations as well. And I became an operating partner at a group called Stone Peak, and Stone Peak's a large infrastructure fund. They manage about $40 billion, and I help them with looking at midstream opportunities, but also, as we highlighted, this energy transition opportunity as well. So, and I thought about this question and looked back over the last 5 years, and you hit it on the head. If I look at my direct investments that I've made and also where I've put my time, it's been in it hasn't just been in energy transition. It's been in fossil fuel investments, and it's also been in energy transition investments. Energy transition, I invested early on in a company called Sonova, which is a residential solar company based here in Houston that was founded by a guy that I used to work with at Enron. I was a small early investor, but I was on their board. They're residential solar panels on top of houses. That's what they did initially. It was hard as hell to get capital 10 years ago, still hard 5 years ago, and now it's given away, it seems like, in the capital space for a lot of these areas. So that would be a traditional, or that would be an energy transition item for sure. Then on the flip side, I have like a hybrid, which is a company called Zenith that I'm on the board of, They're an above-ground liquid storage company that's international in nature. So when you fly over the ship channel, when you fly over New York, LA, these are all those above-ground terminals you see. We store refined products, crude oil, and chemicals. Well, they have shifted in the last few years to kind of items around the hoop, as I would call. They handle renewable diesel. So that's an energy transition product that they handle, but at the same time, they're handling traditional fossil fuels in that regard. So I call that a hybrid. And then on the other side, I've got an interest in a power plant company that I'm president of as well. It has power plants in Texas, and it's pure fossil fuel. There's no other way to say it. But it's been impacted by the energy transition because if you look at the deck within Texas itself, the grid has definitely moved much more to wind, solar, and other product. But that's created volatility in pricing for power, where quite bluntly, if the wind doesn't blow during certain times of the day, or if solar's not working, things have to turn on immediately. And we have these super peaker power plants that are that kick in. It'll be funny, during the freeze last week when everyone was concerned about power and are we going to have a problem with the grid. It's interesting. These plants that I have an interest in, they turn on at $200 a megawatt hour. In rough terms, people out there in power, you know what that is. But that's really high prices. That's the short of it. We didn't run any last week, but we ran this week. Ran 2 nights ago for about 30 minutes. We ran 3 nights ago for about 15 minutes. So it's interesting in that's the volatility. And the reason we ran is the wind just didn't show up. It just, it was predicted to, but it just didn't show up. So it's interesting to me, and I'm in complete agreement with you. I just think you need a balance. I think most companies need a balance. That's just my personal opinion, whether it's private or public. But there is so much, Walker, there is so much capital wanting to go into this space on energy transition, and there are going to be winners, but there are going to be losers. There are going to be some things that don't work out. There are so many management teams running around with ideas, and some of them are great, and I think they're going to make it, but I think others who won't. And the reason they're running around is there's just the amount of capital chasing it. I don't know your view, but to me, it's more than even in the shale days. There's just such an emphasis on finding that. So I guess I would say be balanced in the approach and thoughtful, because I'm in agreement. I think you're going to need investment in both sides, energy transition and traditional.
Thank you. Good morning. Hi, my name is Rose Sink. I'm actually a frog mom. I'm not a TCU alumni. I graduated from Texas A&M, and I'm thrilled to be here this morning with you. I'm the Cfo of Motiva Enterprises. We are a wholly owned subsidiary of Saudi Aramco. We own the largest refinery in North America over in Port Arthur, Texas, that processes 630,000 barrels of crude oil a day. We provide fuel to the south and the eastern coast of the United States, and we market that fuel under the Shell brand and the 76 brand. So when you fill up at the Shell station in Texas today, you'll be fueling with Motiva's fuel. I'm very happy to be here today, and I'm very interested in what you guys have to say. I'm 20 years with Shell Oil before I came over to Motiva about 8 years ago. I agree with all that's been said before. I believe there's a balance that's going to be necessary for the energy transition for decades to come. As you can imagine, if you've been watching the news, we've had more than 1 million barrels of crude oil of refining capability taken out in the U.S. So we've had refineries shut down all across the United States, and that will continue for the coming years. And what you'll see is demand is continuing to increase in the world, and supply is becoming less and less. So while we are all in favor of energy transition, it's going to take a while. And in the interim, we need the oil and gas industry to continue to invest and to bring those reserves out of the ground so that we can process them. Back to what Walker was saying, when you look at the investments in upstream CapEx over the 2014 to 2021 period, it's been cut in half, 50% less investment in the upstream industry. We're still going to need that crude oil over the next several years. So I'm sure you're seeing it around the world as you see there's demand for product, and we're seeing it in lots of places where there's demand and not enough product to go around. So my view is, we need the balance, as you guys have both said. We're not there from an energy transition perspective. We're saying by 2050 we'll be carbon neutral, which of course we're all in favor of. But what it's going to take is $150 trillion of investment over the next 30 years, and how realistic is that? And so today, when you look at conventional automobiles, they're still 99% of what's being driven in the world. Again, I'm not talking about the U.S. because I realize we're a developed country, and we are moving faster. But it's about reliability, it's about affordability, and it's about sustainability in the world. And we have a long way to go.
Great. Good morning, everyone. Great to get back to a little bit of normalcy in terms of getting people together. Michael Jameson, I run the global energy business for Citi. I graduated from TCU in 91 and really have been in energy or finance since that time. So I have a long history in this industry. Not to repeat certainly what was said here, but agree with everything. But what we have been doing from our perspective is really trying to capture this energy transition momentum. And we've done it in two ways. At the corporate level, we have mandates in place now from a city perspective for our Scope 1 and Scope 2 emissions, but also Scope 3, and really trying to work with industries. And it's not just energy, it's transportation, it's manufacturing, it's a whole host of things. Work with industry to try to figure out solutions for carbon emissions and energy transition and ultimately things of that nature. More on a micro level, we have reorganized our business. We used to just have an energy business, but we've pushed that together with our chemical and power businesses, as there's really a confluence of opportunities across those industries. But importantly, added a fourth leg to the stool, and that is our clean energy transition business that we stood up last year. And what that business is really meant to do is identify those companies that are looking to form new technologies or create opportunities to facilitate that energy transition momentum that's obviously occurring. And so we're in the front of all that, but importantly too is to create really the experience and knowledge of what all that means. What does hydrogen mean? What does carbon capture mean? How do companies ultimately capture those opportunities? What are the costs behind that? What are the economics behind that? David is exactly right. There is a tremendous amount of capital in search of energy transition, whatever that might mean. And what we have seen over the course of the last really year and a half as private equity, for example, or infrastructure funds have really looked to put capital in what is defined as energy transition. And I think what a lot of those funds have seen is that the returns and risk aren't really congruent. And so there's really a lack of ability to generate a return for that capital. And there was a period of time where they were eschewing fossil fuels investments really for that. What we have now seen is that that's coming back. And a lot of those private equity and infrastructure funds are starting to put capital back into traditional fossil fuels. There are returns there. Certainly the price doesn't hurt from that perspective. But it's a really interesting dynamic as you think about the flow of capital. I do believe, David, to your point, is that there will be a lot of losers as it pertains to trying to put capital behind the energy transition. It's important technology. It's here. Companies have to adapt to it. But at the end of the day, people need to make returns on ultimately those investments. Our energy transition effort, there's 850 companies that we are actively tracking, looking for, again, whatever that energy transition dynamic is that they're trying to solve. So it's a huge, huge market. A lot of people running around trying to figure things out. A lot of capital trying to back those teams and what have you. But I think it's going to be a really interesting, next 5 to 10 years as companies look to, figure out what this all means.
Michael, I think that great point, and I think that everyone's alluded to the fact of the capital restraint and lack of investment, is going to put us at a place where there's going to be a gap. I'm curious from your perspective at Citi, how do these where are you seeing the most success from these existing traditional energy companies
in regard to how they're funding, moving to some kind of clean energy technology or source? Where are you seeing the most success in that in their internal transitions?
Yeah, and that's an excellent question. Thanks for asking that, because I do think that what's important to understand is the current companies that are existing in energy, whether it's upstream or infrastructure or downstream, we believe will be on the forefront of energy transition. And if you think about it, those are the emitters, right? So that's where the source of capture ultimately could occur from a carbon capture perspective. When you think about renewable fuels, hydrogen, whatever the case may be, these companies currently have the infrastructure. So when you think about the sequestration of carbon, there are reservoirs that can be used for that. The technology that is ultimately being created, these companies have development activities, they have a lower cost of capital, they have the infrastructure, they have the engineering, they have the commercial aspects of putting transactions together. Our belief is that really the leading energy transition is going to be done by those companies that are currently in existence. Certainly there's going to be technologies that are created on the power side and in the solar and wind. That will be done by obviously incumbents there as well. So our where we're focusing our time and attention is certainly trying to make sure we understand who the winners and losers of the 850 companies that we're tracking might be, but it's really focusing on our current client base, making sure that we're providing capital, that we're providing strategic advice to those folks to be in front of their own energy transition, and ultimately we believe will ultimately be leading the energy transition over the course of the next several decades.
And how are you defining that? Like when you're meeting with your clients, if you can claim we think city will be a part of leading what this looks like from, taking advantage financially of some of these transition points. Do you point to anything specific in regard to future technology or future?
Well, I think the future technology is yet to be adapted, right? And I think when you look at this transition to all electric cars, it really isn't feasible, at this point for that to happen. The electrification of everything isn't really feasible in terms of the raw materials that are needed for that, the physics behind it in terms of some of the applications. What we're really trying to do is identify to those clients is that there is a need for energy transition. The ability to retain capital or raise capital is going to be pushed on them by a measure of what are they doing for that energy transition, again, carbon capture and things of that nature. Their ability to ultimately invest in things and get either equity or debt capital is going to be an important consideration as they think about what they're doing for their transition needs.
Okay. I think Walker, David, you both in your firms are investing in some electronic vehicle infrastructure, right? I don't know. Talk to us about how you went about making that decision, what fed to it, how's it going? Yeah.
See if I can get it to work again. Yes, I think what you're referencing, at least on the electrification of vehicle side. So I'm an operating partner with this group called Stone Peak, big infrastructure fund. And last year, we ended up making a commitment, Stone Peak did, into a company called Moody. Moody's based in the West Coast. It's in San Diego. And what they have is what's called a vehicle-to-grid technology, where they have charging stations where you can charge vehicles, but also their technology allows you to dispatch that electricity back into the grid. And specifically for Stone Peak, what was interesting to them, and again, it's really tough, as Michael says, within these firms to find these investments that potentially will hit the return thresholds that these groups want, because it is different. They're not interested in 4 to 6% unlevered returns, and there's a lot of renewable type projects that those are the returns. So in this electrification of vehicles, the pitch is $750 million commitment to electrify school buses throughout the country, because there's a big push, both federally, but in a number of states, to take diesel buses, think of the buses that a lot of us all rode on to elementary school, and convert them from diesel into electricity. Take that one step further. So you go to a school district, you say, we'll replenish your entire fleet of school buses. You, school district, sign a long-term agreement with us, 10 to 15 years, where you'll lease the buses from us, we'll maintain them, keep them up, and then over time, it's not right now, as Michael highlighted, but over time, we'll be able to sell that power at some juncture potentially into the grid. Because again, a vehicle like a school bus used in the morning, afternoon, not used during the middle of the day, not used at night. So when they go back in and plug up, you could almost have mini power plant parks, if you wanted to call it, throughout the country, where again, you've got these vehicles, they're not going to be used in the evening. They can dispatch into the grid at that time in that regard. And that's the technology that Moody has. But it takes a while to convince school districts, other constituents that are involved to do that process. So I think we have a structure that works as far as within Stone Peak, but to that one investment, they looked at a ton of others to get to that juncture, and we'll still have to see if it works. To date, we haven't deployed that capital. We've been assisting that management team with going in and talking to these school districts, but it's a process, and we'll just have to see how it ends up working out. But it is a pretty unique technology in that regard.
It's just so hard to find things. As Dave mentioned, with they looked at many companies before making their investment. Last year, we at Pickering made an investment in Merge Electric Fleet Solutions. And I'll be honest with you, we did it the same way we usually have done upstream, midstream, or oilfield service investments. We found a talented executive team, and we believe that they can execute on a business plan. Because what we see, and by the way, their business is they are electrifying corporate fleets. So they go out to the Permian Public E&P company that has 500 trucks, and they said, hey, you are absolutely getting slaughtered and hammered in the media for being an evil energy company. How about an easy win? You can convert your fleet to an electric fleet. These guys will handle the charging, secure the vehicles, do the use cases, monitor and maintain. And we are batting about 1,000 on people going, and how much does that cost? You tell them and they say, that's a great idea. And so the guys are working pilot projects, not just in the energy industry, that's why they selected us to be their equity provider, but also in home health, in, believe it or not, HVAC companies that care about this, that have 50 trucks up to 250. So, but the problem is, we've looked at probably 200 companies, and we're smaller than Stone Peak. Stone Peak pays more in office expenses than we do in making investments. But we have put $15.5 billion out since 2008 in mostly traditional energy. So what we're scouring the earth trying to figure out is, think for a second what David said. He said that last year, y'all remember, we didn't have power in Houston, friggin' Texas. Okay, so think about that for a second. We had 21 living things at my house. 7 adults, because families and friends had to come over, they had no power. No, 8 adults, 7 dogs, and 6 kids. I wanted to kill myself. And now we had heat, and we had power, but no internet or TV. It was a long 2 or 3 days. We're talking about Houston. Think about getting energy to the Waziristan area of Afghanistan, or even think of an hour outside of, pick a major city, right? Go anywhere in sub-Saharan Africa. So what we're trying to think about is where are the investments that we can make, because we're not going to take venture investing risk and get private equity or infrastructure or high yield fixed income returns. We will be out of business if we do that. And unfortunately, there's a lot of capital that is going into this space that I believe is taking venture risk but going to get single digit returns or less. For every Amazon we had the last time, there was a pets.com. Now Chewy actually works now. We have 3 dogs, right? But how long did it take us to get from pets.com to Chewy? So it is very complex on trying to select investments. And the problem is, for the Stone Peaks especially, and it even hits us as smaller guys, it is hard to put a lot of money out. Venture investing is usually $500,000 or $1 million or 2 to 3. It is not what's your average investment you need to make at Stone Peak. And for us, we really would like to put 10 or 20 million to work at a time. And it is wildly difficult in this. So we did make a company investment, Merge Electric Fleet Solutions. It was challenging. We will make more, but I expect our investments going forward are going to be more where Michael was talking about, probably the intersection of traditional energy and energy transition, which sounds completely BS-y, right? Like, oh, that's something you see on like a coffee cup of somebody who's trying to sell you something. The reality is there are energy companies today are well capitalized, more so than they've been ever. They're not drilling outside of their cash flow. Hey, look at the public companies today, like the TCU students did. Their free cash flow is up historically high. They have the money to spend and figure out what technologies will work, and they're going to have to do it because of the consumer pressure, the government pressure, and to be relevant. But as our former Secretary of State, the CEO of ExxonMobil, Rex Tillerson, once famously said, is that ExxonMobil is a hydrocarbon company today, and it plans to be one for at least the next 50 to 75 years.
Yeah. No, it's interesting. We just took a group of energy MBA students to France on their geopolitics course for a week, which for a lot of folks, they go, why in the world do you go to France? And the impetus of the trip is to go to the IEA and kind of dig in and figure out, where are they pulling their numbers? How are they getting these projections? And then we go down to the south of France and look at the ITER site, the only nuclear fusion site, and our students get firsthand exposure to all of that. But to your point, I think the interesting challenge is that a year ago, everybody, it's just been a year since this shift of we have to invest this way. And now let's backtrack a little and find a way to make these traditional approaches and the alternative ones, in a way moving forward. And that is not the rhetoric in Europe at all. So I don't know, globally thinking, Rose, I'm gonna start with you here and getting a little bit outside of our domestic space. And we talked a little bit about this last night too. If you had to pen an alternative energy, would there be one that you think could handle this transition? And if not, that's okay too. We'd just like to pick your brain on that.
Yeah. Thanks, Ann. Great question. So what I would say today, when you look across what we have with solar and wind, it's 2% of the global energy mix. So very, very small. A lot of investment to get us there, as you guys were saying. I agree with what Michael said, and that's basically that energy companies need to be at the forefront of ensuring that we lower our carbon emissions, because we're the ones that are emitting it today. And so I believe we can invest in things like blue hydrogen, things that produce lower carbon, emit lower carbon, carbon sequestration, like Michael said as well. Those are the things that we're looking at and investing in. Some of this, I talked about the refineries that are rationalized, that are closing down. A lot of those are being converted into biodiesel, types of refineries where they're creating some biodiesel to go into the mix. So I believe we're going to be at the forefront. I think that, there's not a single alternative energy today that would be affordable for the world, because you think about you think about some of the underdeveloped countries. They can't afford electricity today, and much less will they be able to afford solar and wind and all the other alternate electric vehicles, or they're riding on bicycles today. We're in a very, very different place in all parts of the world. So what we're trying to do is to reduce emissions as quickly as possible. And I'll tell you, we're an investment grade company, so we have rating with S&P and with Moody's. We have to go out into the capital market as well and get our capital. Our banks are asking us, what are you doing in this space? The energy sector is becoming less and less of the portfolio of these banks that we deal with. So we're having to prove that we're reducing our emissions. We have some huge electrification programs going on in Motiva, and I wanted to say proudly during the Winter Storm Uri last year, we were actually able to export to the grid and power more than 70,000 homes in Port Arthur, because our refinery came up and we were able to do that. So there is a lot of good that's happening as well in this industry, but I don't disagree with any of my colleagues up here that we've got to move on. That's where the capital's coming. One of the things we did in Motiva last year, we produced our second sustainability report ever. So we hadn't been doing that in the past. We're a pretty new company. And then secondly, we've gone out and gotten a third-party rating from Sustainalytics. This is a company that does ESG ratings. It's important to us from a banking perspective, from an insurance perspective. They're all asking us, where do you stand? And actually, we were in the top 6% of all energy companies in the world. So I believe, energy companies are waking up, some of them, some of the IOCs, and like you said, Ian, in Europe, they're all just getting out of the industry. Mm-hmm. My belief is we need to lead the transition, and that's what we intend to do.
Well, I love that. I don't think we could say anything more, more on spot than that. I want to save some time here if we have questions from the crowd. I have a list here I've made of 5 or 6 more, but just from your comments. But let's see if anyone in the audience has some questions for our panelists. Right here, yeah.
I loved your comment about Sustainalytics. We spend a lot of time in the ESG space. I'm curious, how much do you feel like the traditional energy business is being involved in these filters and, it's been a big debate on how you actually measure impact. And so we see so much capital flowing to new technologies, where really the improvers are the place where you're going to make the biggest move. Are they engaging the industry enough to be involved in what this new filter or analytics looks like?
Yeah, that's a fantastic question, and I'll tell you the way it happened to us. Sustainalytics goes out, and they're not the only company in the world that does this, but they're one of them. They go out, and with whatever public information exists, they create a rating for you. And we're a privately held company, so there's not a lot of public information about us. So they did their own report for us 2 years ago, and we did not like the outcome. And so as a result of that, we got very involved. The next year, we provided them data. We showed them what we're doing in both the E and the S and the G space. And we like the outcome there. So I think what's happening is, at public companies, it's not a problem. But for private companies, they're forcing the industry to get out and make known where they are. Because the banks are asking us, the insurance companies are asking us, what are you doing in this space? And when you can have a third party say, actually, Motiva is pretty fantastic in this space, it helps.
Yeah, there really needs to be a standardization of what that all looks like, because what ultimately is happening, in particular on the private companies, but even on some of the public companies, the banks and insurance companies are making their own estimates of what's happening. And some people are further along than others ultimately, but I think that the industry is starting to work towards more of a standardization, but right now we're not there. And I think there's going to be some missteps along the way as investors, banks, other constituents make decisions with bad data. So that data piece is ultimately going to have to get better. And I think it will. I think that we're moving rapidly towards that, but right now there's kind of a hole in terms of what is really happening out there and ultimately how do you measure.
We just started teaching an ESG course at the Neely School to the undergrad fellows, our honors students there, and then also in our MBA students are currently enrolled in an ESG issues class. And what's been fascinating, I'm teaching that course and have been digging into this curriculum really, intensely and intentional for the last year and a half to try to make some sense of how do you tell an MBA student that has one class to take where the majority of the world is telling them you've got to figure out how to measure these in order to get the support that you need. And my takeaway thus far after putting a lot of time into this has been exactly what you're talking about, Michael, just to back that up, and that there is so much discrepancy across all of the, Sustainalytics is just one, right? There's 99 of them. And there isn't one that even the SEC is pointing to that is saying, this is the rating agency, this is the company we should use. There is no standardization right now. It is the Wild West. And it's impacting, financial value of public companies, all of them. I think 98% now are somehow submitting what they're doing in ESG and having a direct correlation to then their valuation, and yet we're all getting to pick. You didn't like the report, so then and so it's fascinating. And I think we are going to be forced. I think the SEC and under this chairman is definitely going to come out soon. And depending on how long this administration's in office, this is a big priority to him. And there'll be something that'll come out that'll at least give a little bit of boundaries that we can start to move in a direction if that's something the markets continue to respond to and want to value. Okay, another question. Yes.
As y'all are looking at the leadership teams when you're evaluating investments, are you seeing primarily, maybe what is the mix of managers and leaders from the traditional, regardless of stream, oil and gas space versus folks who are maybe coming from tech or otherwise outside, seeing opportunity to get into the transition space?
I mean, I'd say overall, I will tell you, just with the technology I spoke of earlier on the vehicle to grid, that was, I would call it definitely technology type of individuals. And quite frankly, in a lot of cases, individuals that aren't accustomed to running larger organizations. I've seen a lot of really good ideas from groups, but they're small groups, and you start talking about scaling it out, and it's hard to have that conversation with that management team early on where you'd be like, well, that's a great idea. You might not be the right party, quite frankly, to take it to the next level. So I've seen a lot of that. I do think there are more management teams that have an energy background that are going into the, I'll call it transition or renewable space, and it's probably taking something that they've learned in the traditional space, a niche or area, and then saying, well, I can see how if I change that, it can be energy transition, renewable diesel, renewable fuels, something they learned in the traditional space, and then take that to the next level with more of a transition bend. So it's been a mix. At least the groups we've dealt with, though, I would say are a little bit more in the technology type of area, haven't led large organizations.
You know, all right, so if you think of a general 10 investments that we've looked at in this space, as high as 4 I would classify as wild ass entrepreneurs. And these are people who are coming with business plans that are mining for crypto, oil in the cloud, and other stuff that just you can immediately just, and you don't get to know the management team because we're not going to mine for crypto, oil in the cloud at Pickering. But of the 6 that have real business plans and you meet the executive team, half are tech venture PhDs, have an idea, talk about patents, and then half, at least we've seen, I'd be interested to see what you all see, are power executives. Actually, they've come from the utility and the power world, and for example, Merge Electric Fleet Solutions we made the investment in, they were the guys at Reliant that had started Reliant's electric vehicle business, and then that turned into EVgo, and they were senior executives there before leaving. So most of those other ones have been power. Maybe of those 10, I'm going to cheat, 0.5 are energy executives that just are trying to do something different because it's been not a lot of fun the last 7 years. But most of them have fallen in those camps.
And I think some of that, to your point on the electricity background or electricity executive, it's because, at least in the interim term, a big buzzword is electrification. You know, there's also sequestration, hydrogen, you're hearing all that. That's further down the road, so it's electrification. So I really think those folks have that background. They're finding ways around the edges that they're like, okay, well, I understand how the market works. Let me see now if I can deploy this new technology and make it work under an energy transition umbrella.
Other questions? Yeah.
I have a question. Going back to what you were saying before about the lack of standardization and the sort of, I guess my question is if you could make a wish for what the government could do to support these issues in new ways, what is it that they're getting right, what is it that they're getting wrong, and what is it that you would like to see? And please walk
So I tell you what's not going right, and that's the renewable fuels. You know, the RVO, it's a mess. The RINs which is kind of the precursor to whatever carbon capture credits are going to be. It's a mess. It's 2022, and we still don't know what the RVO from 2020 was. So I'm looking at financial statements yesterday of some of my peer companies who took huge gains in December because they went ahead and wrote on their best guess at what the EPA is going to do with the RVO from 2020. So difficult to compare ourselves to peers. So I will tell you, if the carbon credit process follows the RINs process or the RVO process, we got trouble. And so that's not going well. I will say, I think making the credits available, making the, all the tax exempt opportunities available, I think is a great thing. And it is increasing interest in the industry. So I think that's good, but I do think the programs they roll out are very difficult to follow. And if you follow any oil and gas companies in the U.S., you can see in every earnings call that's what the CEO is talking about. This quarter, RINs did this or did that, and it's ethanol blending. That's all it is. We've made it way too complicated.
David and I said under our breath, "Stay out of the way." I was an Air Force officer during Iraq and Afghanistan, and so I had government health care, and we called it the medical hobby shop. I have found very few times in my career that the government is a good solution or a provider of solutions in any instance, and I think that our industry is no different there. And I think the confusion that what is going on, and it's not that they need to win votes and get elected, so they're going to continue to talk about it, but I don't believe I would ask for or expect much out of the federal government. We have more luck here at the state level potentially, but even that, as you see across the country, is fraught with complexity.
Yeah, I generally believe in keeping government out of the way, but I do think where ultimately this may end up is much like audits and financial audits and things of that nature, and it's likely for public companies anyway that there will be a compliance piece of the ESG measurements, and someone will ultimately have to sign off on it. There'll be a liability attached to it, and so it'll start to get a little bit more focus. You could see that ultimately coming into play, and then that will then transition into private companies who will adopt that type of measure. We're not there quite yet, but you certainly could see, I think, maybe it happening from that perspective.
Yeah. Another question? Judd?
Do y'all perceive that there will come a time, and this was kind of alluded to earlier, that a lot of these renewable energy sources are not as environmentally friendly as the public would believe that they are? And I think what was mentioned was battery technology, mining rare earth minerals. So that's kind of part one of my question. The other one is, never in human history have we gone from a more energy or less energy dense source to a less energy dense source. And so that was also alluded to, and I think when the public kind of realizes what we're setting ourselves up for with this growing supply-demand gap, I just don't know how that turns out other than extremely high prices for everybody. And maybe just some thoughts on how that plays out.
Well, that's you're going to me? Yeah, exactly. I think it's a good point, and I think at times, as you're highlighting, I do think the general public is unaware of those other raw commodities that go into producing solar panels, wind turbines, the energy intensity to develop that in that regard. I do think that's not getting played out. And also, let's say certain pundits are right, and crude oil is not used much in the future. It really went down. Well, let me tell you something. Those raw materials, that if crude oil is not what we're chasing, if that's not $100 a barrel, there's going to be something else that is. Copper, I can go through all the raw materials, and those in a lot of cases aren't produced in the most stable countries in the world either. So I think you're right. I don't think it's being, the public generally understands that as much as they need to. As far as how it plays out, I think what you hit upon is correct in that there's going to be volatility in prices for oil. I just see that for much more volatile than it was 5 years ago. So we'll see how the education process goes overall in the future.
And sorry. No, please go ahead. And even in Kazakhstan today, you see that what's happening there with the pickets and strikes and all that, and it's about the rising price of their fuel, and that's just one place. As I said, as more rationalization occurs around the world, there's going to be more demand, less supply. We're going to see more of that.
120 years ago, Houston was a small city, and the big city was Galveston. until the storm of 1900 hit. That was 120 years ago. Most of the world, just 120 years ago, was wood burning heat. In parts of the world, animal fat, oil. Then you had heating oil. And then the energy mix over the last 42 years has included nuclear, solar, natural gas, hydrocarbons. I mean, through the whole system. So I think that we will have if you look at that chart, if you think of, let's go back 200 years, and it's wood burning here that starts to go down, but it's not gone, right? There's lots of parts of the world that still use wood burning heat, right? That's
850 million people.
That's right, and that's when we talk about energy poverty,
Yeah.
which is something that is also not being talked about, and it won't be, because you're not going to sell advertising space on CNBC talking about that. It's just not. It's not going to happen. So the reality probably is that graph with wood burning going here. We had nuclear, remember, popped up, still in Europe, but still down here because of accidents. Coal, right? You'll have a chart that will have 8 or 9 or 10 colors on it. And so it won't, you're not going to see the sharp drop off even of wood burning heat. So think about that for a second. So the reality is waiting for the public to wake up about energy poverty, or that we need 2.5 times the copper produced last year just to hit the EU's goals for electric vehicles. 2.5 times the copper we mined globally last year in order to hit just the European Union's goals for electric vehicles. That's not going to be out in the public discourse. The way that it will change is through investing in the financials, because where the money goes is what will end up showing where the winners are. But I would expect a graph that has 10 to 15 different colors on it for the energy mix.
Yeah, and to that point, that graph has never seen a decline in energy usage. And that energy usage is going to continue to go up. And so the layering of additional technologies or sources or whatever the case may be is going to be important, because demand is going up.
I think a closing thought, and then I know we're trying to get everyone out of here by 9. What's important too is this same concept of moving forward, and then a deep breath of rewinding just a little bit. I mean, the EU just came out last week. Typically the leader in pushing a clean, green energy solution, and any of the big world forums that are happening. COP26 just recently happened, where Europe tends to be very vocal about the direction that we source our energy from, and they just came out last week and said we need to reconsider nuclear and natural gas as clean energy sources. So again, that retraction, I think, is, we have overreacted, certainly, and I think we all want a cleaner, greener planet, right? I don't think anyone would ever argue with that, but the idea of the ways that we can get there, and the ways that we can financially support these, and I've loved the diversity of your backgrounds and your yet having some similar opinions on how things are looking moving forward. Just keeping all of that in mind, and want to thank you so much for your time, for continuing to support our university in this way, in the intellectual thought of how we move forward and getting in front of our students. That's going to be our hope at the Energy Institute, now that we're under the Neely leadership. It's a 15-year-old institute that was very much focused on natural gas, I think because of Fort Worth and the Barnett Shale. That was a natural fit in 2006 when it launched, and has been in various places around TCU, but now has found a home at Neely. Is this idea, let's talk about solutions in a way that aren't political, and really look at financially, how can we be successful here? How can we teach our students how to go out and contribute to the companies that they're going to be working for in this space, or the companies that they're going to start in this space, and make some money, but at the same time do a lot of good. And that's our hope for our students at TCU. We're going to keep investing in that human capital piece, and certainly need your help and support to do that. That's the only way it happens. I know our tuition dollars keep going up for some of those that currently have students there. Or I know a future parent here in the room, Patrick Trask, and that has an incoming freshman coming up this year. And it's still, we need more to do more. It's just the reality of higher education, and I think TCU is knocking it out of the park. I think that ranking that David alluded to is huge. We're the only business school in Texas in the top 20. That's something to be proud of. I'm really, really proud to be affiliated with this school. We have a thoughtful strategic plan that 45 board members contributed to on where we think the direction of the Energy Institute should go. If you're interested in that, I did bring files for you to have some, really exciting reading this evening. But if you want to know what we're planning and if you want to contribute to that in any way with your ideas or your thoughts, I would welcome that. So please stay in touch. Thank you guys so much for coming. Really want to thank Jen and Judd, too, for putting this on, and then Dean Allen for coming down from Fort Worth. Ryan, you did a miraculous job here. I'm so impressed every time you throw an alumni event. So thank you to everyone again. Thank you. Appreciate your time.
Don't forget your phone again. Yeah. Thank you. Fun time.
Awesome. David, it's really nice to meet you.